Welcome traders, Maciej here from Taurus Trading. In this video you will learn the basic concepts of the financial markets structure. If you want to become successful and have a long-lasting career as a trader, it is crucial to understand fundamentals of the very environment that you are about to operate in each day of your journey to financial freedom. So let's get started. Financial markets create liquidity that allows businesses to grow and entrepreneurs to raise money for their ventures. They attract funds from investors and channel them to the corporations. This way, businesses can finance their operations and achieve growth. The term market is sometimes used for what are more strictly exchanges, organizations that facilitate the trade in financial securities. In example, a stock exchange or commodity exchange. This may be a physical location such as the New York Stock Exchange or London Stock Exchange, or an electronic system such as Nasdaq. Much trading of stocks takes place on an exchange. Still, corporate actions such as merger or spin-off are outside an exchange, while any two companies or people for whatever reason may agree to sell stock from the one to the other without using an exchange. Within the financial sector, the term financial markets is often used to refer just to the markets that are used to raise finance. For long-term finance, the capital markets; for short-term finance, the money markets. Capital markets consists of stock markets, bond markets, commodity markets, money markets, derivatives markets, futures markets, foreign exchange markets, cryptocurrency markets, spot markets, and finally interbank lending markets. Stock market is a place where shares of public listed companies are traded. The primary market is where companies float shares to the general public in an initial public offering to raise capital. Once new securities have been sold in the primary market, they are traded in the secondary market, where one investor buys shares from another investor at the prevailing market price or at whatever price both the buyer and seller agree upon. The bond market, often called the debt market or fixed income market or credit market, is the collective name given to all trades and issues of debt securities. Governments typically issue bonds in order to raise capital to pay down debts or fund infrastructural improvements. Publicly traded companies issue bonds when they need to finance business expansion projects or maintain ongoing operations. The general bond market can be segmented into the following bond classifications, each with its own set of attributes: government bonds, municipal bonds, mortgage-backed bonds, and emerging market bonds. Derivatives are complicated financial products that base their value on underlying assets. A derivative is a contract that derives its value from the performance of an underlying entity. This underlying entity can be an asset, index, or interest rate, and is often simply called the underlying. Derivatives can be used for a number of purposes, including insuring against price movements, so-called hedging, increasing exposure to price movements for speculation, or getting access to otherwise hard-to-trade assets or markets. Some of the more common derivatives include forwards, futures, options, swaps, and variations of these such as synthetic collateralized debt obligations and credit default swaps. Most derivatives are traded over the counter or on an exchange such as the Chicago Mercantile Exchange, while most insurance contracts have developed into a separate industry. A commodity market is where companies offset their futures risks when buying or selling natural resources. Since the prices of things like oil, corn, and gold are so volatile, companies can lock in a known price today. Since these exchanges are public, many investors also trade in commodities for profit only. For example, most investors have no intention of taking shipment of large quantities of pork bellies. Futures contracts are the oldest way of investing in commodities. Futures are secured by physical assets. Commodity-based money and commodity markets, in a crude early form, are believed to have originated in Sumer between 4500 BC and 4000 BC. Sumerians first used clay tokens sealed in a clay vessel, then clay writing tablets to represent the amount, for example, the number of goats to be delivered. These promises of time and date of delivery resemble futures contract. Forex trading is a decentralized global market in which currencies are bought and sold. About 6 trillion are traded per day and 88% involve the US dollar. Almost 1/4 of the trades are done by banks for their customers to reduce the volatility of doing business overseas. Hedge funds are responsible for another 11%, and some of it is speculative. Financial centers around the world function as anchors of trading between a wide range of multiple types of buyers and sellers around the clock, with the exception of weekends. Since currencies are always traded in pairs, the foreign exchange market does not set a currency's absolute value, but rather determines its relative value by setting the market price of one currency if paid for with another. The money market is a component of the economy which provides short-term funds. As money became a commodity, the money market became a component of the financial market for assets involved in short-term borrowing, lending, buying and selling with original maturities of 1 year or less. There are several money market instruments in most Western countries, including treasury bills, commercial paper, bankers' acceptances, deposits, certificates of deposit, bills of exchange, repurchase agreements, federal funds, and short-lived mortgage and asset-backed securities. A market can be described as a money market if it is composed of highly liquid short-term assets. Money market funds typically invest in government securities, certificates of deposit, commercial paper of companies, and other highly liquid, low-risk securities. A cryptocurrency is a digital asset designed to work as a medium of exchange. Individual coin ownership records are stored in a ledger existing in a form of computerized database using strong cryptography to secure transaction records, to control the creation of additional coins, and to verify the transfer of coin ownership. It typically does not exist in physical form like paper money and is typically not issued by a central authority. Cryptocurrencies typically use decentralized control as opposed to centralized digital currency and a central banking system. When a cryptocurrency is minted or created prior to issuance or issued by a single issuer, it is generally considered centralized. When implemented with decentralized control, each cryptocurrency works through distributed ledger technology, typically a blockchain, that serves as a public financial transaction database. The spot market or cash market is a public financial market in which financial instruments or commodities are traded for immediate delivery. It contrasts with a futures market in which delivery is due to at later date. In a spot market, settlement normally happens in T+2 working days. In example, delivery of cash and commodity must be done after 2 working days of the trade date. A spot market can be through an exchange or over the counter. Spot markets can operate wherever the infrastructure exists to conduct the transaction. In the over-the-counter market, trades are based on contracts made directly between two parties. and not subject to the rules of an exchange. The contract terms are agreed between the parties and may be not standard. The price will probably not be published. The interbank lending market is a market in which banks lend funds to one another for a specified term. Most interbank loans are for maturities of 1 week or less, the majority being over a day. Such loans are made at the interbank rate, also called the overnight rate, if the term of loans is overnight. A sharp decline in transaction volume in this market was a major contributing factor to the collapse of several financial institutions during the financial crisis of 2007 and 2008. Banks are required to hold an adequate amount of liquid assets, such as cash, to manage any potential bank runs by customers. If a bank cannot meet these liquidity requirements, it will borrow money in the interbank market to cover the shortfall. Some banks, on the other hand, have excess liquid assets above and beyond the liquidity requirements and will lend money in the interbank market, receiving interest on such loans. I hope this video was valuable for you and that information that I have provided will help you in your trading career. If you don't want to miss my new videos, which are already in the works, make sure to subscribe to this educational channel. By the way, I have recently put together a lot of valuable content regarding financial markets, so feel free to grab a copy of my ebook. Link to the website is in the description. I hope to talk to you soon.